I'm going to tonight chat about the 5 ways to make money in a difficult market. And once again, I'm going to apologize. My voice is a little bit croaky, got a little bit of the flu, so I might have to take the odd cough break. But anyway, let's launch in. Okay, so I'm going to talk about the 5 ways to make money in a difficult market. And I think most of you will agree that the last month or two has been kind of interesting in the markets. And we've had some nice volatility coming in, which for the traders, it's something we can trade. But for the investment buy and hold type clients, maybe getting a little bit worried. So what I want to chat to you about tonight is show you how you can either bank, keep your profits in a tough market. I'm not going to really share trade ideas. I think what I'd rather do today is talk about a couple of different ways, 5 ways, that I think you can look at your investment portfolio and come up with different ways of trading or different ways of thinking. So my slides tonight, I'd like to challenge you to trade or think differently about the way you invest. So I'm going to use a lot of the S&P 500 charts. There's a lot of data on those charts. And you can go and find these charts. This is from JP Morgan Asset Management, a very nice chart of the S&P 500. And this is just to set the scene. So for those of you a little bit older like me, who've been around a while, you've probably been through a couple of these dips. So you'll remember that we had that nice run up, the tech boom, the market moved up over 100%, and then we had that 49% pullback, which hurt. And then we turned around in early sort of 2002, 2003, and we started the next bull run, which ended with the financial crisis of 2008, and then we had a pullback in 2009. And then we've had this very, very long, prolonged bull run. And we've had a couple of real bumps along the road. But in general, it's been pretty good for investors. And I mean, as you can see from that chart, it's probably time for one of those little sell-offs. So here is the bull and bear market since 1946, just to give you a feeling for after every bull market, there's typically a little bear market. And we've had 10 since 46. And you'll see that the bull runs tend to be longer than the bear markets. The bear markets normally are fairly short, fairly aggressive. And you can see it's listed on that slide there, the last 10 sell-offs. And typically some of those sell-offs have been in the magnitude of 40-50%. So when a bear market does hit, it hits hard and it hits quick. The other thing about bear markets or movements within the year is that sometimes the inter-year declines are actually greater than the annual. You know, we typically look at annualized charts and we look and say, what did the year do? But in between those years, you can actually have a sell-off and then a recovery. So sometimes annual charts lie. So interestingly, if you look at sort of 1988, market was down 34%, but closed only 2% down for the year. So you actually get intra-year volatility that's sometimes greater than what the annual charts tell you. The other thing is that if you're an investor that gets involved in the market in the age of 20 and you then trade the markets or invest in the markets at the age of 65, you're probably going to find that you're going to have to put up with this volatility more often than you thought. So my slide here says, don't sweat the small stuff. Well, in fact, if you have 45 years in the markets, so you get involved at the age of 20 and you go in the markets till retirement at 65, you're probably going to experience more than 150 dips. Now, those dips are 5% or more. So you're going to have to put up 150 times with slight movements down of 5% or greater. And that's going to happen about 3.5 times a year. You're going to experience that. And that's why I say don't sweat the small stuff, because you probably don't even want to worry about that, because you're going to get that 5% back fairly quickly. You're going to then experience 45 corrections in your life, in your investment life stage, or in your lifetime. And a correction is a movement of 10% or more. And you're going to get 123 of those over your life. Well, 45 corrections, typically about one a year. And then we have the bear markets. They've been 32 in the life stage of the Dow Jones, and you're probably going to pick up one every 3.5 years. As you've experienced, the last one was in 2008. We've had about 7 years since the last time we've had a proper bear market. And a bear market is 20% or more fall. And on average, you're going to get about 13 of these in your life stages. but more likely about eight or 10 of them. And those are the ones we really have to worry about, because if you're getting close to retirement, a drop of greater than 20% is going to take away a substantial amount of your capital, and you just won't have time in the market to recover it. So as I said, don't sweat the small stuff. Some research here from Signia, and they looked at the local markets, and they said that over the last sort of period of time, we've had 4 bull cycles, 3 bear cycles, 7 in total. A bull cycle has given you 82% return over 50 months on average, and the bear cycle takes away 28%, and that's typically in about 15 months. So you can see the bear cycles are always much shorter. They're about 1/3, less than 1/3 of the length of the bull cycle. Bull cycle gives you more, 200% return. Bear cycle takes away on average about 28%. So where are we in the cycle at the moment? So this is a chart of the S&P, and it looks at the PE ratio in the S&P. And it's got one standard deviation away from the average, which sits at about 15.7. So currently on a historical PE basis, well, this is a forward PE, the market doesn't actually look that expensive at the moment. So I think, although we've had this prolonged bull market, I think we're not quite at the end of it yet. I mean, this thing can certainly, stocks can get a little bit more expensive than they are at the moment. But anyway, so let's talk about setting yourself up for just in case. What would you do, or what should you be doing towards the end of a bull market? So the first one is, of course, diversification. And it's still the only free lunch in the financial markets. So interestingly, there's my little smarty box of asset classes. And really, I don't expect you to look too much at the slide. And in fact, the slides will be available afterwards, so you can look at this in more detail. But you can see that asset classes come and go. They sometimes vogue, they have the top performance, and then they have the worst performance. You'll see on this slide that the commodity over the last sort of 4 or 5 years, the commodity cycle has actually been the worst performing asset class. So what this tells you is that you can't just get stuck in one sector or one asset class. You need to mix up stuff in your portfolio to create a nice diversified portfolio. And you need to look sometimes at last year's laggards or the last couple of years' laggards and maybe put those into your portfolio as this year's performers. The other thing you need to do when you diversify is look at correlations, because what you want to do is you want to add things into your portfolio that have lower correlations with each other, because there's no point in adding a whole lot of highly correlated stuff into your portfolio, because it will all just move together. So what you can see is, if you take the US large cap, you can see bonds have a negative correlation, currencies have a negative correlation, market neutral has a very low correlation, 0.6. So you must pick some of these asset classes and put them into your portfolio, and what it will do is protect you in one of those down markets. Surprisingly, and this is why they say diversified portfolios are the only free lunch, as you add some of these non-correlated or negatively correlated asset classes, what actually happens is sometimes your returns go up, but your volatility or your risk goes down as well. So it is possible, by mixing a nice blend of diversified portfolio, to actually achieve slightly better return at slightly lower risk. And I know that sounds crazy, but that is the free lunch of diversification. So you'll see there, if you have a 70% stocks and 30% bonds portfolio, by adding alternative asset classes and having a 60-20-20, you've actually increased your return and you've decreased the risk in your portfolio. And that is the free lunch. So as a layman, the question would be, how do you go about doing that? So, well, fortunately, what we've got is a couple of portfolios or a couple of trading systems that you can actually add some of these different asset classes to your portfolio. So if you've got a pure equity portfolio and you want to add, for example, FX, we have a relationship with Glenn from Practical Pips, and we have a Practical Pips FX portfolio, and you can put a little bit of that into your portfolio, and it will certainly diversify. And the good thing about something like an FX portfolio is it's looking to do positive returns every month that's just non-equity correlated. You could also look at adding commodities, gold and silver. We have a relationship. And then that other one at the bottom there, which is the bull and bear, is our head-to-head portfolio, which is our pairs portfolio, which just looks to make consistent returns every month. So it's more like a cash plus 3 or a cash plus 4 type portfolio. So you can start adding these sort of asset classes to your existing equity portfolio, and that will create that diversification. It should bring up your return, should bring down your risk. So that's rule number one. If you want to protect your portfolio against some of the sell-off, diversify. Second one is, the best defense is good offense. And that's normally rugby players and football players who tell you that. But even in your portfolio, if you're starting to get nervous, become defensive. If you've got a portfolio full of good growth momentum stocks, which have done exceptionally well for you in the last 6 or 7 years, those high beta type stocks that have given you all that performance, maybe it's time to switch it up a bit. Maybe start looking for more of the defensive stocks. I'm not saying go and look for deep value plays. I'm just saying look for a little bit of defensive stocks to put into that portfolio. And you don't have to be a good analyst, a fundamental analyst, to come up with these. The market does it already for you. So, for example, here's the S&P 500 low volatility index. And what I've done is I've plotted the low volatility index versus the S&P 500 total return. And you'll see that the low volatility index has actually, on average, outperformed the S&P every year since it started in 2005. And during a falling market, the low volatility index, that's a basket of low volatility stocks, actually doesn't go down as much in a falling market and performs slightly better in a rising market. So on average, the S&P is giving you 7.65%, and the low volatility basket is giving you just over 9%. Now I know most of the listeners are going to say, yeah, but I don't trade the S&P 500, so how do I get involved in these sort of things? Well, fortunately, you now have got ETFs, South African-based ETFs that do exactly the same. So Core Shares, which is Grindrod Asset Management, have launched a whole lot of these sort of baskets themselves. So they have a low volatility basket, and it's been running since 2009. And once again, you'll see that over 5 years, it has actually outperformed both the FTSE Top 40 and the SWIX. It's a better producing, it produces better returns, and on the right-hand side of that slide, you'll see at lower risk. So the top 40 has a standard deviation of 18.4%, and the S&P South Africa Low Volatility Basket is actually 11.4. So you've reduced your volatility by about a third, and you've got better returns. So if you're a stock picker, what you can either do is you can go and buy this ETF and put it into your portfolio, or you can drill into it and say, what are the top 10 constituents, and buy some of those shares and add them to your portfolio. So depending if you're a bottom-up stock picker and you want to pick stocks, or if you just want to go and buy a whole bucket of beta, smart beta, you either buy the ETF or buy the stocks. So that's the one way of adding some defensiveness into your portfolio by using low volatility. Second one to look at is go and have a look at this thing called Dividend Aristocrats. Now, this is not the dividend index, the dividend plus stocks. These are the Dividend Aristocrats. These are stocks that constantly produce dividends every year, and they're not the highest dividend performing. These are guys that have got consistent dividends and don't miss. So once again, I've started with the S&P 500, and you'll see if you bought a basket of Dividend Aristocrats versus the normal S&P 500, you would have actually done about 3% better per annum than the S&P 500, and you would have done it at lower risk. So once again, let's take this concept back to our local markets. And once again, Core Shares have got a Dividend Aristocrats now ETF, and they've back tested this to 2009. They launched it in the last year or two, and over 5-year performance, the Dividend Aristocrats has beaten both the SWIX, the Top 40, and the Dividend Plus Index, and beaten it quite handsomely. So it's about 3% better over the 5-year period, and it does it with less volatility than the market. So this is kind of a bit of a no-brainer. If you're thinking the market is getting a little bit expensive and you're getting a little bit worried about growth stocks, have a look at adding both the low volatility ETF and the Dividend Aristocrat ETF. And of course, someone's going to ask me in the Q&A later on, what is an ETF? So an ETF is an exchange traded fund. It really is just a basket of stocks where the portfolio manager has already created that index in that basket of stocks so that you don't have to. And there I've shared with you at the 31st of March what were the top holdings in that ETF. It was Capitec, it was TFG, EOH, Dana Bank. So if you're a stock picker, once again, you can go into their portfolio, have a look at what they're holding, and buy the stocks rather than buy the ETF if that's what you choose. So that was step number 2 in my how to make money in a possibly a volatile or dangerous market. Look at low vols and look at dividend stocks. The other way of doing it is what I call live the alternative lifestyle. I'm a great believer. We are a hedge fund manager. We are a 2A license, and I do like alternative assets. And I think you should add these into your portfolio. Not massively, just as I was showing you earlier, add some commodities, add some market neutral. Sorry, everyone, I'm going to have to cough. I'm going off air. So I'm back with you. So as I said, I'm a great believer in alternative asset classes. I think everyone should have hedge funds, commodities, these sort of things in their portfolios. So and normally adding alternative assets is very difficult. But if you kind of have been following our profitology, now profitology is my baby. It's Stephen. Sorry, can you? The guys are telling me they can hear me. That's great. Profitology is one of my babies. I've been working with Stephen on this. Profitology is clearly the art and science of making money, and we have great guys writing for us. And the one I've put up here is Greg Canglias's article. And this is I'm not saying to go and buy alternative or hedge fund managers, but start thinking like them. So here's an article that Greg put out saying the one ratio that can depict the direction of the gold and oil market. And I think you need to start thinking like this. You've got to start looking at ratios, things in the market that are not just pure normal technicals. You've got to look at these sort of things and say, let me act like a hedge fund manager. Let me think differently. So what Greg did there was look, and the gold oil ratio is a very common ratio that people do follow. It's the gold price divided by the oil price expressed as a ratio. And what Greg's done is had a look at the average of that over the sort of last 40 odd years and then made a view. And the view is at the moment the gold oil ratio, 20.35, is quite high relative to the monthly average, which is 15.4, which is what it's been averaging over a long period of time. And normally when the ratio goes above 20 or goes below 10, it's not sustainable. And what you expect is that something will happen between that gold versus oil ratio. Now, and I'm not saying to you that I'm a gold bull and that I'm going to go rush out and buy gold. All I'm doing is I'm looking at gold and oil as a ratio between them and then kind of coming up with some trading ideas. So what Greg is saying is to bring that ratio back down to its average, gold might have to fall to 1,000. That's a scary thing, gold at 1,000. And oil might have to advance to 65, which is terrible for our fuel tanks. But that will bring the ratio back to 15.4. Or gold stays where it is at around about 1,100, and oil moves back up to 71, back to its sort of 60 to 80 range that it used to be in. I mean, that's good for you guys holding gold stocks, but not great for us guys who need to import oil and put it into our fuel tanks. Or gold goes up and oil goes up. That would be great for the gold bulls, not great for those of us holding oil. It'd be great for us. So there's a couple of different ways you can play this ratio. One is, if you think oil price is going up and it's inflationary, etc., well, probably the market's going to come down. And if gold is going to shoot up, that's typically because there's been some event risk, and that normally means the market is falling. So if this is going to happen, then look to go short maybe on something like the Beta Beta or the Aussie. Also, it tends to be a euro against dollar play. It also means stay away from those highly beta industrial, high valuation stocks that you've been getting used to. You've been eating lots of pies in that sector. You've been having lots of these retail consumer stocks in your portfolio. Maybe start to lighten on those. The other way to look at it is to buy oil and short gold against it. And I'm not saying that these things are going to come to pass, but all I'm saying to you is look at those sort of ratios that Greg is looking at and start to think differently about the market. It's not just about going and buying high growth, high momentum stocks. It's about thinking about all these other factors that are affecting the market and start to bring those into your thinking. So that's lesson number 3. Think like a hedge fund manager, or start to think about those alternative ratios. Lesson number 4, and it's an article that we're sending out today that's been written by Singer in Profitology. Let volatility work for you. Now there's this wonderful thing called the VIX. It is the most well-known index, maybe not well-known to South Africans, but well-known certainly to guys in the US. But the VIX, the volatility index, is the market's most accepted measure of risk, stock market risk. It's called the investor's fear gauge. And really what it is a composite of the puts and calls on options on the S&P 500. So the biggest index in the world, it's the optionality on that. And it kind of gives you a feeling for whether the market's scared or not. So Singer is sending an article out today. And I thought, let's go and have a look at some of the things he's looking at there. And I must say, I'm one of the guys who trades the VIX. I sit here in South Africa and I trade the volatility index in the US. And you can do that in two ways. You can either trade the IDX futures on our local SAFEX exchange, on our EDM exchange, or you can go offshore and you can trade the VIX directly. You can trade the futures on it, or you can trade one of the ETFs, the CFDs on one of the ETFs on the VIX, something like the VIX, the iShares VIX ETF. But here's what we kind of look at. So you can see there, the VIX has been moving between reasonably steady for the last couple of years, between 12 to 20. And I've been trading that range. So when it's below 12, below 13, close to 12, I tend to get involved. I go long the VIX and I buy what I think is protection, just in case the market is going to get hit. And then when it gets to about 20, I start lightening. And I'm trading that as a speculator. But you guys, to hedge your portfolio, could add VIX into your portfolio at about 12, and that will give you a lot of protection that if the market takes a big hit, you're going to make money on the VIX and you're going to lose money on your equities, and hopefully you get compensated out of that VIX trade. The other thing that you've got to watch is when the VIX gets up to about 30, and you can see it does that, it's done that a couple of times during very volatile periods, it's probably time to lighten the load of your stocks, get out of some of your stocks, or short the market, or hedge your portfolio, or definitely do what I said at the beginning, add some of that low volatility and those dividend plays into your portfolio, because there the market is going to be taking a serious hiding when that VIX is sitting up there, because it is telling you that there's massive volatility in the market. So VIX is there as your gauge. You know, the other gauge that we have, it's not quite the VIX, but we do a thing every Monday. It's done by Robbie Pietropalo. He does what he calls his share traffic control. And the share traffic control really is just looking at the top 40 stocks. Well, we look at the financial stocks, the resource counters, and the industrial counters. And we put together a composite of all of that and say, do we think the market is strong or do we think the market's weak? Do we think the market has got upward momentum or downward momentum? And we've got a little gauge, which is our own fear and greed kind of gauge. And we send that out every Monday. So I welcome all of you to please drop us a mail or go onto our website, register to get Robbie's share traffic control, because that'll give you a feel for the sort of top 60 odd stocks that we look at and whether we think the market is expensive or cheap. So very much like this VIX indicator. The other thing about volatility, it's kind of interesting. When the market gets volatile, everything starts moving together. So this is once again JP Morgan Asset Management, great little chart this. But you'll see at the bottom there we've got the VIX, but at the top we've got correlation. And that's the correlation across all large cap stocks. And you'll see when volatility spikes, the correlation of all the shares moves together. So you get correlations of 60, 70%. So the problem is there's nowhere to hide. So when the market is getting really hit and the VIX is going up dramatically, all the stocks will be moving down together. So even though some of those low vol and some of those dividend stocks will protect you a little bit, most stocks will move together here. So it is one concern here that just moving between stocks when the VIX is spiking is really not going to help you much. It's probably better to add other asset classes in or hedge your portfolio or exit some of that portfolio. The other thing about exiting, and this is timing the market. It's very difficult to time the market. So here's some very good research by Ned Davis Research. And it's basically when you say, I want to use the VIX to get out of the market, well, getting out of the market is very difficult because If you're invested, so here's an example of the S&P 500, and it's over a long period of time. And it says, if you're invested for the entire period, so you've gone through all those ups and all those downs that we looked at earlier, you would have made 11.7%. If you decided to exit the market because of the VIX and you got worried, and you happened to exit and you missed the best 10 days, the best only 10 days in all of that time, you would have got 9.3%. So just getting out of the market for the best 10 days actually cost you 2.4% of your portfolio, of your returns on average. If you missed the best 20 days, you're suddenly now left with 7.7%. And if you missed the best 50 days, so let's jump to the right-hand side of that chart, you would have only got a return of 4%. So even though I'm saying to you, when volatility is high and it's probably good to hedge and it's good to exit, understand if you miss the good days of the markets, it has a serious hit on your portfolio or on your total return. So market timing, you need to be really sharp if you want to do market timing. The other thing to protect your portfolio when the VIX is high is to hedge, but I really don't want to talk too much about hedging today. I think that's the meat of another presentation. I'd like to have another presentation just about hedging, because I think that's a science. As I say, profitology is about the art and science of investing, and I'd like to deal with that another day. The other thing you can do is short the market. So that's not hedging. This is actually going short to make money when the market moves above those normalized levels. And I think we can do a whole another day about shorting, because shorting, once again, is a science. And then you can do like I do. You can speculate and you can purchase low volatility. So when volatility is sitting at about 12, buy it. Look, use it as another tradable instrument and look for it to spike. So the other day, vols were sitting at about 12, 13, and vols are currently back to about 16, 17 again now. So you could have made some money on that trade. So that's another way of playing volatility. So that was lesson number 4, trade volatility. And then my last one to trade off, that I think this is what I do every day of my life. And one of my colleagues next to me, Michele St. Angelo, is pairs trading. It's a very, very simple concept, but I call it trade like a hedge fund manager, because pairs trading is a very, very simple thing for most of our retail listeners to get involved in, or retail traders. Now, there's a lot of information on that slide. You can read it when you download the slides later or view the presentation again. But essentially, pairs trading has been around a long time. Since about the late 70s, early 80s, a lot of the hedge fund managers or investment banks have been doing this in the States. And basically, all you're doing is you're matching off a stock you think that's going to go up against a stock that you think is going to go down. And why you want to do this is because what you're doing is you're taking the market risk out of your portfolio. And I call it my head-to-head strategy, because I'm literally putting 2 stocks together head-to-head, and I'm expecting one to go up and one to go down. Now, lately, it's been very difficult to determine one single stock against one other single stock. So what I've been doing is I've been doing retail sort of baskets or bank-type baskets or IT-type baskets, where I pick a couple of good retail stocks and I short some very poor retail stocks against it. And I create my pair that way, by not just going with 2 stocks, but by mixing a few stocks together. And typically what I do is I look at about the top 80 shares, and I look to find stocks that have got quite good correlations with each other, and I trade them against each other. So I'm going to show you an example of doing this, and it's very, very simple. And forgive me, this is an old example, but it's a goodie. It's ShopRite versus SPAR. So clearly what you're doing in this trade here, you pair them up. So in your charting package, if you've got one, or on your trading front end, you take the one stock and you divide it by the other, and then you look at it over time. And you do your technicals on it as though it was a share, an individual share. Now you can see that ShopRite SPAR during 2012 was trending very nicely upwards and then got into a sideways pattern. And you can see it came down and did a sort of almost a double bottom there. And I was getting interested. And I was saying, yeah, it's broken out of that trend that it was in, that sort of sideways to upwards trend. And it had pulled back both on the dailies, pulled back on the 30 minutes, it had pulled back on the weeklies. And it had got to a level at 1.18 where I was very happy to buy the ratio. So effectively what I was doing was I was buying 200 shares of ShopRite and shorting 236 shares of SPAR against it at a ratio of just under 1.18. And I was looking to take profit at 1.22, so I was looking for it to recover back into its channel. Or my stop loss was at 1.16, which was the previous low. If it broke there and went down to that inclined trend line, I was going, well, I've made a mistake. And my risk-reward ratio on this was 2.25. So I always like on my trades to have a slightly more than a 2-to-1 risk-reward ratio. So not very complicated. I'm buying one share and I'm selling another share against it. And as you can see, there's my little logo on the bottom here. It's my bull versus bear. Really all I'm doing is I do look at these every day. So does my colleague McKelly. And you can phone our trading desk or you can subscribe for my head-to-head service. And you can get a couple of these pairs trading ideas. And they work. My last 3 months in my head-to-head portfolio, it's not going to sound overly exciting to you guys, but I'm up 20%. I'm about 18% in the last 2.5 months. And that's in a market that's gone really nowhere. So pairs trading does very well in a volatile market. So I'd welcome you to think about these sort of trading strategies, different trading strategies that you can add to your portfolio. So those are my 5 things that I think you should look at. So let's just run through them again before I talk about the survival checklist. The first one, diversify. Add different asset classes. Add commodities. Add FX. Add hedge funds. Add alternative thinking to your portfolio. And it will diversify your risk. It'll give you better performance and it'll bring the risk of your portfolio down. Diversification, the only free lunch left in the industry. Secondly, look at different ways of playing the same sort of S&P or top 40 movement, but by doing with the dividend aristocrats or the low volatility. Thirdly, think out of the box a bit. Come up with your own ratios, like the gold oil ratio. Start trading that sort of mindset. Start thinking differently to the herd. Fourthly, trade the volatility. It's out there. Either use it as to time the exit out of your portfolio, but be careful. Remember that how much you would miss out if you missed out on the top 10 days, or trade volatility. And fourthly, trade pairs. Think like a hedge fund manager. Start coming up with those sort of strategies that are slightly different to everyone else. So whether that's pairs trading, whether that's high frequency scalping, come up with something that works for you. So those are my 5. They're not things that you can rush out and implement immediately, but hopefully that's 5 concepts you should think about including into your trading strategy. So I'm gonna finish off by talking about the difficult market survival checklist. First one, don't try to outrun the bear. You're not going to be able to time this market. Stock market declines are normal and frequent. You've seen that. You're going to get 3 this year, small little sell-offs of 5% or more. You're going to get at least one of 10% or more, and you're going to get one in the next 2-3 years of 20%. Live with it. So don't try to time the market. Unless you're someone like me who sits in front of a screen, don't time it. But what you should do, don't sell quality investments. These are the times when you should accumulate. I don't want to sound like a Buffettologist now, but when there's blood on the streets, you should be buying. You've got to buy good stocks in falling markets. It's the time to accumulate those great quality stocks. So don't try to outrun the bear. Use the bear. Also, remember, bear markets are over quite quickly. They're shorter than bull markets. Average last about 15 months, and they have about a 30-odd% sell-off, about 28% in South Africa. But the bull market will come back, and they typically last about 5 years. They're going to give you, in South African terms, about 200% return. So as I said in point number 1, use the bear market to accumulate the good stocks because they will pay back. And the other thing you can do is if you're in a unit trust type product, keep contributing because you will be buying into a falling market and you will get great stocks at good prices. And then don't forget, bear markets historically followed by bull markets. So they present an opportunity. So if you've had the last severe bear market was about 48%, it rebounded almost all of that in 1 year. So you got your money back in a year. So the only guys who really need to be worrisome about a bear market is anybody close to retirement. If you're close to 65 and you're going to really need that capital, then you're going to have to worry about that the next year or 2 or 3 might give you a bear market. I think that's the only scenario where you have to be worried about the bear. Anyway, so that's kind of me for this evening. Sorry about the croaky voice. I'm going to apologize about that. I am going to answer. I'm going to ask you to throw out some questions. Really, I'm here. I'm here for your entertainment. Um, Someone just popped up saying we're not seeing the slides, but I mean, I think that might be. I think that might be you, not because nobody else has said that. Okay, fire away, guys. Let's take some. Let's take some questions. I'm feeling up for the challenge. How often can you realistically use the ratio you mentioned? I'm assuming that might be referring to the gold oil ratio. Um, I suppose the answer to that is as many times as it's relevant. Um, yeah, as I said to you, there's a sort of peak and a trough. So when it's down by 10, it becomes interesting, and when it's above 20, it becomes interesting. When it's in the middle of the road at about 15, it's not going to be very useful. So I suppose as many times that it sits at the extremes as many times as you can use the gold oil ratio. And there are other ratios out there that you should start looking at. So for example, the gold silver ratio, the gold platinum ratio. You know, there are some of these other ones that you can have a look at. There's another question there. I just want to see. Can we get the slides by mail? Yeah, so we're going to record this session, so you can download my recorded session. Plus, if you don't want to listen to my voice in the recorded session, you can certainly we can make the slides available to you. There are my details, Mark Wheatman at Vunani Private Clients, and that's my phone number. If you want to phone me and have a chat about these things, you can certainly have the slides. Okay, next question from Durban. How often does share traffic control go out, and how do I use it? So as I said, share traffic control, it's a weekly bit of technicals that Robbie puts out. We did stop it for a while we were just cleaning up the methodology. It started again about a week or two ago. As I say, it goes out every Monday to our clients, and it covers the financial, the FINI 15, the Resi 10, and the Indy stocks. And so there's about 50 odd stocks that are covered in that. And what we do is we give you a feeling for where we think we should be buying, and where we think we should be selling, and what we think the momentum on that stock is. And then we give you an overall feeling for each of the sectors, those three sectors, and an overall feeling for the market. And hopefully you will find that useful. The other thing you can use is that we do a morning report. And in that morning report, we have our support and resistance levels in there every day. And we also have our pivot levels. So from from a short-term trading as well, we're very happy to give you our pivot levels every day in our research. And we think you should trade around that. Okay. After the stop, I've not received the STC again. Who do I contact to reinstate? If you're not getting share traffic control, do me a favor, just drop me a mail. My email's there. Most of you know me. Or you can mail Stephen, or you can contact Robbie directly. But send it through to me. I'll make sure you get put onto the email address. I must say what we have done over the last couple of weeks, guys, is we have changed email servers, and we have cleaned up our email, our bulk mailing. So if you're not getting mails from us, please let us know, because you've probably been dropped, unfortunately, off one of our lists. So please just send me a mail. Interesting. Okay, so Yako asked me, what happens to your pairs trading service or your pairs trading once the market crashes? Well, I love volatility with pairs trading, because pairs trading in a rising or flat market where nothing's happening is rubbish for a pairs trader like me. It's awful. I get nothing to trade. There you might as well just be buying momentum or buying growth stocks, sticking with it. What I actually need is meltdown in the market. I need volatility. So in the last couple of months with this volatility, I've been loving it, because what happens there is shares move apart. So Spar, ShopRite will diverge, and I'll be able to trade them. So banks will move apart. In a rising market where everything's moving the same, those banks don't tend to diverge too much. What happens in a market crash as well with a pairs portfolio? Because you're long one stock and short the other, the market falls, but your portfolio will hopefully not fall. I've hopefully immunized you against that market fall. So hopefully that answers what happens in a pairs portfolio. Let's see if we've got any more questions. Okay. Okay, I've got one more coming from Jonathan. Can I use copy trade to follow your pair service? Yeah. So obviously Jonathan has come across copy trade on either our website or when we've been chatting about it. So copy trade is something that we've been playing with for a couple of years now. It used to be branded Follow Me, and literally it was about, guys, these are our trade ideas, follow us. And that was our Follow Me service. And what we did was we saw what the guys were doing offshore in terms of social trading and copy trading, and we got our own trading ideas, but we've also gone out and sourced other trading ideas for you. So, for example, Follow the White Rabbit, Practical Pips, Gold and Silver. These are third-party guys that we brought their intellectual property in-house or working with us to develop these services. And what you can do with our copy trade service, you can automate that trading. So if you unfortunately away from the desk and you can't see when one of our gold trades goes out, you can copy trade and follow the gold silver guys, or you can follow Glenn on the FX, or you can follow Robbie on smart trading, and we will automate that using our copy trade service. And what we will do is we will do the exact same trade that lead trader or that master trader does in his trading service. We'll do it for you, and we'll put you in at exactly the same levels. We'll take you out at his take profits. We'll take you out as his stop losses, and stop losses do happen. So certainly, if you're interested in copy trade, please drop me a mail, drop Greg at Vunani Private Clients also a mail, and he can get you going with copy trade. I don't see any more. Is there a follow me option on the Bulls versus Bears? So yeah, there is actually. So that's head to head Bulls and Bears. I've only got a couple of guys following me on that. I don't know why. Most of our clients don't seem to like pairs trading. They find it kind of boring. I like it. It works for me. And yeah, I've got some guys following me on that. I'm actually the lead trader on that. So I'll tell you how that works. Copy trade for me and following how we work. We put Vunani money, our own money, into each of those portfolios. So every portfolio that we have in copy trade has our own money in it. So boy, when we're losing money, we also feel it. So head to head, we've put Vunani money into head to head, and the results, I call it real trading, keeping trading real in our copy trade. It's real portfolios, it's real money, real traders for real returns. And that's why I call it keeping it real. So we have Vunani money in that head to head portfolio, and if you'd like to copy us, and I am trading quite a few pairs at the moment. I'm quite active in June and July. Not been so active this month. Been looking around for a couple of things to get involved in. But if you'd like to copy me on those and follow my trades, more than welcome. You'll be then knowing that you're following the CEO of Vunani with Vunani's own money, so you should feel quite secure. Okay, let's see if we've got any last ones. What type of gearing would the VIX index have? That's a very good question, because that depends on the sort of instrument that you're playing. And as I said, this Singer's sending out this article on profitology, so I don't want to steal his thunder. But there's a couple of ways to play that VIX. So if you go and buy the iShares ETF on the VIX, there's no gearing at all on that. It's a one-to-one. So that wouldn't be very exciting for me, but for an equity portfolio client, to put that in an equity portfolio would be fine. You can then trade the CFD on the iShares ETF offshore. That'll probably give you about a 10 times gearing. And then the other way to do it is on an IDX future, which is the international derivative futures that we have locally on our local exchange. And that will sit about 8 to 10 times gearing. So there's a couple of different ways of playing that VIX. I'm sure there are other instruments out there that are more geared than that. We can have a look around for you. But I think that 10 times gearing is probably enough for most people. Okay, that seems to be it. I don't seem to be getting any more. Anybody want to find me a last question before I sign off? Nope, it looks like everybody's had enough. Thank you very much, everybody, and thanks for joining me. I really do enjoy these sessions. We're going to do much more of them, and And I hope you enjoyed it, and I hope you learned something. That's me signing off. Cheers, everyone.